What if I told you you're probably missing out on some tax deductions that could literally save you thousands of dollars in taxes? Would you want to know about them? Well, I hope so, especially if you are a small business owner, a startup, or some type of freelancer, because today in this video, what I want to do is share 10 tax write-offs that many entrepreneurs often, very often overlook. And I'm going to start with the ones that I think are least often overlooked and build up to the ones that I think you're probably missing. So if you're excited to learn more, then all I ever ask is that you hit the like button for the YouTube algorithm while the intro plays. Hey there, and if you're new, welcome to the channel. I'm Sean with Life Accounting, the accounting company that helps people to save on taxes and build more wealth. All right, now look, if you are not taking advantage of tax deductions that you already qualify for, then you are literally wasting money. So let's go ahead and dive in with tax write-off number 10, the vehicle tax deduction. Now, I know a lot of people already know about this tax deduction, but there are many misconceptions around it. And so what I see is that oftentimes people totally overlook it because they don't think they qualify. So let me address a few of these misconceptions. First off, do you need an LLC to take the vehicle tax deduction? Well, the quick and dirty answer is absolutely not. As an independent contractor or someone who receives a 1099, you can take advantage of the vehicle tax deduction, which means if you identify as a freelancer or a sole proprietor and you drive any amount of business miles, then you qualify. You see, the business structure mainly determines two things. Number one is going to determine how your business is taxed, and number two is going to determine how much legal protection you have. So 99% of the time, you are going to get the same tax write-offs as any other entity, with a few exceptions for corporations, but usually even those are minor in the big scheme of things. All right, another popular question or misconception is, do you need a new vehicle to take the vehicle tax deduction? And again, the answer is no, but I do have to break this one down a little bit more. All right, so there are two methods with the vehicle tax deduction. You have the standard mileage method, and you also have the actual expense method. So with the actual expense method, you are allowed to take depreciation. However, if you decide to take depreciation, then the vehicle must be new to the business. Okay, let me say that again because that often trips up a lot of people. The vehicle must be new to the business, but that doesn't necessarily mean the vehicle must be new. All right, so for example, hypothetically, I could buy a 1999 car and use it in my business, and since it is new to my business, I could take depreciation on it. Although in that scenario, the depreciation would be very, very low because, well, the cost of the car would likely be low. So going back to the question, does the vehicle need to be new? Well, no, if you are using the standard mileage method, because that can be used for any business or vehicle. And yes, if you are using the actual expense method, but only if you're trying to take a certain depreciation. Now, another misconception is people thinking that the vehicle needs to be over 6,000 pounds. And once again, the answer is no. Okay, the 6,000 pounds only comes into play if you want to accelerate your depreciation and basically try to write off the entire expense of the vehicle in year one. Because having a vehicle over 6,000 pounds allows you to take advantage of Section 179 and take bonus depreciation. But all that can get a little bit advanced, so definitely don't let that stop you from taking the vehicle tax deduction. All right, so now that you understand that, let's move on to tax write-off number 9, education subscriptions. But really quick, before I move on, I want you to know that we're starting to accept more clients into Life Taxes. So if you are interested in working with our team on tax planning, tax preparation, and more, just click the first link down in the description below to book a discovery call with our team. Now, we only have a limited amount of capacity to take on new clients. So if you are interested, don't wait. All right, so number 9, education subscriptions. How many of us are subscribed to things that we no longer use or we just completely forgot about? Whoa. Okay, so here's the thing. These subscriptions are necessary for helping you run your business or build your business. And ordinary for the type of business that you have, then you can write them off. Think about your subscriptions like your Audible subscription, your YouTube Premium. Like right now, you're learning a lot on YouTube from us about optimizing your taxes, business courses or coaching programs. And another big one are magazines, because oftentimes what I'll see is entrepreneurs who have physical locations have subscriptions to magazines, right? Like if you have magazines or other materials in your waiting room or in your lounge, then that can be deducted as a business expense. But so many people simply forget about it. And I know, okay, these aren't like super huge tax deductions, but hey, if you have your bookkeeping in order, then these are very simple tax deductions that you can take advantage of, and every little bit counts. And of course, you can write off other ordinary and necessary education expenses like your conferences, your masterminds, your events, and so on. And if you really love what you do, this can end up being like a mini business vacation that you can use to deduct against your income. All right, moving on to tax write-off number 8, I have retirement contributions. So when you have a full-time W-2 job, many companies will offer some type of retirement benefit like a 401k as an incentive to get you to work there, as well as give you some potential tax savings. But you can also do this as a self-employed individual as well. But many times when we start working with our new clients, we find out that they stop contributing to a retirement account after they quit their job. So it's kind of one of those things that you know you should be doing, but you aren't doing simply because you either forgot about it or maybe you didn't know you could do that as a self-employed individual. And if that's you, then I want you to know you have a few options. And some of the most popular options are, number one, a SEP IRA, which allows you to contribute up to 25% of your income up to a maximum of $61,000 for the 2022 tax year. Option number two is the solo 401k, which allows you to contribute $20,500 for the 2022 tax year. And lastly, I have option number three, the simple IRA, which allows you to contribute $14,000 for the 2022 tax year. So those are three popular ones. However, that's a very simple high-level overview of these retirement accounts, and there are many others. And you shouldn't really choose based off the numbers alone. There are many other factors to consider, but there's too much for me to cover in this video. However, if you want to see me make a video all about retirement accounts and retirement planning or anything else, just tell me down in the comment section below. Tax write-off number 7 is business debt interest. So you may have gotten a loan to start a business or expand it, and now you're paying the interest on it every single month. And it sucks, right? Well, here's some good news for you. You can deduct the interest payments on the business debt. Not to be confused with the principal payment, okay? But rather the interest on the debt principal. But this doesn't just apply to a traditional business loan, okay? It also applies to business credit cards or the SBA loans or even a loan from an investor. Now, I know there are some people out there that may accidentally mix their personal finances with their business finances, and all that can get tied together. So if that's you, then I would highly recommend you make sure you're keeping a strong record of everything. And ideally, you get the funding in your business name so you don't have any problems with the IRS if you were to get audited. All right, moving on to tax write-off number 6 that you may be missing, I have payment processing fees. So you know those annoying processing fees that you pay to PayPal or Stripe or just your general credit card processing fees? Well, this is another one that I often see business owners leave out simply because these processing fees can be very small. But remember, every little bit counts. And guess what? As your business grows and you start processing a higher volume or you start doing bigger transactions, then this starts to add up a lot. And if you're in a high enough tax bracket, this could save you thousands of dollars in taxes. For example, if your processing fees are $10,000 and you are in the top tax bracket of 37%, well, simply writing off your processing fees could save you an extra $3,700 in federal tax payments. And once again, as long as you have your bookkeeping in order, then keeping up with these processing fees shouldn't be a problem. All right, moving on to number 5, I have hire a veteran. So let me just say this first, okay? I am not promoting that you discriminate towards hiring a specific group of people or anything like that. I am simply sharing that if you hire a veteran, then guess what? You can get a tax credit. So here's the deal. When you hire a veteran, then you can take advantage of the work opportunity tax credit, which is usually given at the federal level and oftentimes at the state level as well. And this tax credit can range from $1,200 to $9,600 depending on factors like how much you pay the veteran and if the veteran is disabled and a few other business factors. But this is often overlooked because, well, of course, you don't want to discriminate, and I believe it is a violation to ask someone during the interview process or before they get hired if they are a veteran. And so for that reason, many employers simply forget to inquire whether or not someone they actually hired is indeed a veteran, and they totally miss out on this tax credit. And tax credits are way more powerful than tax deduction in some ways because you get a dollar for dollar in tax savings. So if you are a veteran and you're trying to get hired, I'm not saying you have to mention it, but it might help you out a little bit. All right, let's keep things going along with tax write-off number 4, meeting space fees. Question: how often have you rented a conference room or hosted a meeting at your home or threw on some type of event? I know many entrepreneurs do this, including myself, and usually when I do it, it's urgent, right? Like it's a meeting I have to have, so I rush and I book a room or I set everything up at my place, and even sometimes I forget that all of that is a tax deduction. And if you're hosting a business meeting at your home, then there's something called the Augusta loophole that allows you to rent your place to your business and receive a tax deduction. But many people don't know you can do that. And here's another thing. Okay, if you're throwing a party and business partners or potential customers or current customers are attending, you could potentially turn it into a tax deduction. So with a few simple tweaks, your birthday party could be flipped into a business tax write-off. Think about it. Or how about the banquet hall you booked, or visiting that co-working space, or something that's a little bit more popular now, renting out a podcast studio or photography studio or a video studio, right? Don't leave this off your list of deductions. By the way, are any of these tax deductions ones you missed? Tell me down in the comment section below so that I know whether or not this information is helpful. All right, tax write-off number 3, I have cell phone expenses. So a big misconception here is that you need some type of business line or some type of dedicated business phone in order to write off your cell phone expenses. And many people don't think you can do anything with your personal phone. I literally hear tax accountants say this all the time. But here's the truth. As long as you are self-employed and you use your cell phone for business, then you can claim the business use of your phone as a tax deduction. For example, if 40% of the time you are on your phone is being spent on business, then you can legitimately deduct 40% of your cell phone expenses. And the same thing goes for your other expenses, right? Your internet, your TV, and so on. The key takeaway here is if you have an item and you're using it for both business and personal use, then you should consider taking the percentage used for business as a tax deduction. Now, the second tax write-off you're probably missing is number 2, startup costs. Did you know that even before you start your business, you can write off business expenses? Yes, the IRS defines these as your business startup and organizational costs. So you can deduct $5,000 of qualified startup costs if you had less than $50,000 in total expenses in the year your business started operating. Now, if your startup costs are over $50,000, then you still can deduct $1,000 for every dollar you spent over $50,000 until you hit that $5,000 limit. For example, if your total startup costs and expenses in year 1 is $53,000, then you can only deduct $2,000, which is the $5,000 minus $3,000. Which also means if you spend more than $55,000 on business startup and organizational costs and expenses in year 1, then you won't get any tax deduction. Now, all of this can get a little bit deep, but I have an entire video where I break down tax write-offs for new businesses using these startup and organizational costs. So I'll go ahead and link that video at the end of this one so you can watch it after you finish. All right, and tax write-off number 1 are clients who don't pay. Don't you just love when this happens? When you go the extra mile and someone doesn't pay you?
Heck no.
Well, here's something to make you feel a little bit better. If you have clients who aren't able to pay you, then those losses may be deductible as a bad debt expense. Some examples of bad debt expenses would be stuff like loans to clients, employees, and suppliers, credit sales to customers, and business loan guarantees. So if someone doesn't pay you, then you may be able to deduct the full amount or part of the amount they didn't pay you against your gross income. Now, of course, getting a tax deduction on your bad debt expenses isn't the same as receiving the entire amount that you're owed, but it does help a little bit. And it's something that many people simply don't know about or they completely forget about when it's time to file their tax return. All right, so those are my top 10. Don't forget to tell me down in the comment section below if you missed any of these yourself. Now, before I wrap up, here's a very important note. As always, if you decide to take any of these tax write-offs, it's very important that you take them the correct way, because if you don't, then you may trigger an IRS audit. So if you want to avoid that, then I would highly recommend checking out this next video that will help you understand how to correctly take these tax write-offs, and I'll see you over there. All right.